Hey everyone, welcome to the Study Wealth podcast. I'm your host, Serge Berger. I hope everyone got well through the summer. We are starting I think, more interesting part of the market, at least from seasonality perspective here, September through December. And, summer can be choppy, it can be confusing. I admittedly would have to say that that's once again been the case uh, this year. What I want to do today is I want to ponder the question here out loud whether we might have a strong equity market, US equity market in September. To give you a little bit of perspective on that, we're going to first go through some historical charts and then we'll see what that surprise factor might be. So I will be showing a few charts on this. Again, if you're watching this or if you're listening to this on traditional podcast channels, don't worry, I will describe these charts so you won't be missing out on anything at all. But for those of you on YouTube, of course, you will see those charts. So, historically speaking, when we talk about the month of September, excuse me, already jumping ahead, the month of September is kind of known to be the weakest month for the year, at least so the statistics go. And to give you a little bit of sort of perspective around that, I want to go through some of these numbers and give you more insight than just some simple facts or statistics to spew. What I'm showing on the screen right now is a very, very simple seasonality chart. And I always have to remind everyone that seasonality, yes, it's a good input, but seasonality alone is a single factor input. It's a one input and it cannot be relied on just, it's just too simple. It's going to work in some years. It's not going to work at all in other years. And, on average, it may or may not work. It just depends on the market environment we're in. So we need to understand what the market environment is. However, since this podcast episode today is about the month of September through the lens of seasonality, let's start with some numbers there. Typically speaking, the volatility in the market tends to increase from late July into basically or through October. And I'll quickly show you a chart here. All I'm doing is sharing a chart right now that shows the VIX, the seasonality of the VIX. And here we are back to seasonality, essentially increasing from August for really late September through October. Now, again, that doesn't have to happen every single year, but that is typically what we tend to see, is a lift in the VIX. And so far, as I'm recording this, we've seen a lift in the VIX. It hasn't been a heck of a lot. So, of course, that begs the question, what may the month of September bring? But that's to give you a bit of an idea on seasonality. And this is more or less the same as saying that we might see equities trade a bit heavier in September. But I will tell you, and you can look at this chart here, September is probably one of the more frustrating months. And I hate to say this after coming out of a 3-month period here right now, which to me has been just, quite frankly, it's been quite boring and frustrating. And I would even throw May in there, even though we've seen, of course, the AI rally come to fruition. But outside of that, it's been quite boring. We're starting to see some emerging trends in energy sectors. In the energy sector, that's one of the things that we're talking about, the clients actively right now, maybe adding an overweight allocation to energy. But that's sort of a side note and not the topic of today's podcast episode. But if we look at seasonality, I find the month of September to be quite confusing. And that is because I think there's so many people that expect September to be weak that what they tend to do is actually prepare for that in the month of August. And I think that's actually what happened this year as well. In August, we saw weakness in the first part of August. And I'm going to, again, for those people that are watching this on YouTube, I'll be sharing a chart right now that kind of shows what happened over the past month or so. And what we can see is we had a drawdown in for the most part in I think every single sector except for energy, and even energy was down just a touch once we got into the latter stages of August. But then a real big relief rally back to the top. And so, in many ways, this becomes a game of chicken. It becomes a game of kind of, who's going to believe in the seasonality pattern that September is weak when everyone front runs those signals? Remember, markets, a lot more people have a lot more information about markets. I mean, there's tools out there right now available, and we, of course, at the Study Trader also make our tools available to our paying clients behind the paywall. These are sophisticated algorithms, and that's the kind of stuff that hasn't really been available to the public or even the many professional investors for very long. So information, as much as it's very, very important, it's now become a bit of a commodity. And statistics like, again, a weak September can very quickly lead to people front running that signal in August. So let's talk about this maybe a bit more succinctly as it relates to this September. But maybe one more point on that. If we look at September, the question is, are stocks always down in the month of September? Well, historically speaking, September has been a down month about 55% of the time. That's not a lot. And even when it's down, the equity market, it's not a huge catastrophe. In fact, I would argue what I've seen is the surprise factor in equities tends to come in August, less so in September. And again, whether that is because people front run these signals, or because there's less people in the markets in September in August than in September, and thus it becomes more difficult to react to something in August. Again, the surprise factor being higher in August than September, I don't really know. I think it's a combination of things usually. It's, again, also why I always prefer to use multi-factor models and not just single factor models, meaning we look at multiple things and not just one thing at a time. So again, keep in mind that there may be some of that happening, and again, more information. So the question, of course, is now what happens if September is strong? How strong, and how would that potentially look? So let me give you a little bit of color on that. And what I'd like to do is I'd like to look at monthly charts right now, or I'm going to describe those monthly charts again, of course, for people that are listening on the traditional podcast channels, which is probably the vast majority of you. So first of all, if we look at the monthly charts, what I'm showing here is a few sectors. And what we're seeing is that, very much like I showed you or talked about a minute ago, that we've had a rebound in the end of August. We can see this now on candlestick charts. So if we look at something like consumer discretionary stocks, the XLY ETF that tracks consumer discretionary stocks of the S&P 500. And what we see there very clearly is a rebound, again, way off the lows. We came off of those August lows and pretty much closed strong for the month. Not up, but not bad. The XLK, this is really, of course, the behemoth. This is the energy sector growth stocks. They are still outperforming by a wide margin. I'll talk about that in a minute. You can see a massive rally off the lows. Now, again, a lot of this can change very quickly. And this is really why, to me, this has been a challenging few months in the market, because if we look at economic data, the surprise factor is real, meaning we can very quickly get to a point where economic data basically disappoints. And I'm going to quickly talk about the job market here in a minute as well. But when that happens, we could see the market react very badly, very quickly, and essentially give up all those gains that we saw off the lows in August. Absent that, and from a trend following perspective, we have to kind of respect that. Absent that, the trend remains higher, which is also why potentially we could see a surprise rally in the month of September. Now, I will also say the last week, Labor Day, the week before Labor Day tends to be a lower volume week. In fact, a very low volume week. People tend to take that week off, at least in the United States, of course. And so from that perspective, we need to pepper that in as well. Like, we can't ignore those nuances. Those are, at least in my view, important things to be aware about. Let's look at another couple of things here. Again, if we talk about surprise factors, and then we'll look at maybe some levels. But one of the things that I think we need to be careful about here is the jobs market. This is certainly one of those things that the market reacted to the week before last, I believe it was, where we had the JOLTS jobs report. This is coming from the U.S. Bureau of Labor Statistics for the month of, I think it was the month of August. We saw actually lower, or was it? It was maybe it's part of July, and I can't remember now. I need to go back and double check this, but I don't want to tell you crap. Yeah, it was for the month of July. We saw less job openings than was expected by quite a bit. And so this is kind of the first data that's less frequent, like monthly data that's confirming that the job market is weakening, and that could weaken at a very rapid pace. It would be my guess. It doesn't have to, but it could, and if it does, that could really very quickly turn this market around to the negative side. So keep that in mind. What would this mean in terms of positioning, and how quickly could we snap back? Well, I tell you, a lot of people are still very negatively, bearishly positioned this market. And from a correlation perspective, I think what's really interesting here is, let me quickly find this here, if I can find the correlation chart. If I don't come across it here in a second, I will just talk about it in different ways. But we are seeing a correlation in the market that has been now happening for quite some time, which basically means that we are seeing whenever economic data has been coming in weaker for the past year or so, what's been happening is that the equity market rallies and the bond market, bond yields start to go down, i.e. bond prices up. Why? Well, the bond market probably has that right. That's the right reaction function. So let me show you this. What I'm going to plot here, again, for those people that are watching this on YouTube, is I'm going to plot the technology stocks, let's call that growth stocks, versus yields. So we can look at, like, for example, 2-year yields, and we'll just kind of see what this looks like. And if you look at this closely, what we're noticing is that there's an inverse relationship. Now, it's not perfect, but it's really the reaction function is that when we get weaker economic data, the equity market says, hey, great, discount rate is coming down, so lower yields, so the bond market rallies, i.e. yields come down, so we have to buy growth stocks. The algorithms, and this is a big important point, the algorithms are tuned that way. And this all brings us to why I think September could potentially be a surprisingly bullish month, absent really bad economic data. That surprises people even more. So what is going to happen at some point, and I really thought this would happen much earlier, like a few quarters ago, and it hasn't happened yet. It will happen at some point. I'm 100% certain of that, or as certain as I can be, of course. Nothing's 100%. But at some point, the equity market will realize that weaker economic data will also mean that there'll be less growth. But for the time being, I think what's happening is when we get these weaker economic data points, and again, they should be weaker to a degree. If they're really weak, like crazy weak, then I think the equity market sells off as well. But until that happens, until we get economic data that's really bad, and in the meantime, while it just kind of comes in a little bit worse than consensus, then the equity market is going to continue to think that this is time to buy growth stocks. Again, the algorithms are tuned this way, right? When algorithms are tuned that way, which is 80% of trading nowadays, volume is algorithms, electronic trading or automated trading, then they're going to potentially push the equity market higher. Now, it's probably going to fail really fast once it starts to fail, but I just want to throw it out there, and I have no conviction on this happening in September. I think, honestly, right now, the odds are probably higher that we have an up month in September than not having an up month. So let's call that 60%. That's not a high conviction, but it's something I want to be very conscious of. Not only the way the equities rallied back in the back half of August, but why they rallied back. And again, equity markets rallied back. If for those people that are watching this on YouTube, you can see the chart. We can see that the equity markets, the last 2 weeks of, and I'm showing growth stocks, technology stocks, the last 2 weeks of August, equities, growth stocks rallied back very strongly. And it was really because of lower yields. Once that flips, and it will flip once economic news gets bad enough, then lower yields will also mean lower stocks. But for the time being, it might be that September, and maybe even beyond that, I don't know, but September for now is what we're focusing on, might be a month where the equity market starts to look at things still marginally positive. And again, a lot of this is not 100%, 80% of it plus minus is algorithmic trading. So Levels. What does that mean? Well, anybody's guess at this point, but if we consider the S&P 500, I mean, if that continues to happen, if the economic data comes in worse, I mean, I don't see why the S&P. I'm gonna stay within statistical sort of deviations here, but I don't see why we can't at the very least get back up to the July highs, maybe even get marginally past that. So for the S&P 500, that might mean 4,600, maybe it's 4,650. I don't know, right? It obviously that those are it's impossible to tell you exactly what the levels are, but I would not at all be surprised if we go even marginally above the July highs if the market continues to look, if economic data comes in worse, but not terribly bad. And I do think the weight of evidence is that is going to happen. For the NASDAQ 100, which is really those growth stocks that I keep mentioning, same thing. We'll use the QQQs for that. I mean, I have no doubt. I mean, they're at this point, the QQQs are literally like 3% from those highs. Maybe the NASDAQ 100 wants to go to 400. That's a 6% move. That might be a stretch, but let's say it's a 4% move. That gets us on the QQQ to 390-ish. A little more, but let's call it 390. Again, that would be marginally above the July highs. So I could imagine that. The good news for all of us that are looking at this is the following: if it doesn't happen, if economic data, if the market doesn't continue to react positively to economic data, meaning bond yields down, equities up as a result of bond yields down, it'll become very, very obvious. And I think at this point, and of course this changes week over week, but I think the signal would be if the S&P breaks and holds below about, I think the first level is 4,400. And then of course, if it breaks below the August low, is about 4,330. We need to have that on a daily closing basis, preferably. So 4,400 and 4,330. If the market breaks below the latter level for sure, the first one's a great warning sign, then the hopes of that strong September are certainly off the table. So how does one position in this September? Well, I would say let's not be, and this is our book, it's not a recommendation, let's not be as short and catastrophically bearish as one would be otherwise heading into a September-October period, because we're where we are in the economic cycle. And again, where we are in the economic cycle, at least in our view, this is the view represented here by the Steady Trader, but also Blue Marlin Advisors, our investment advisory firm. The house view for right now is that we will see this all happening, and it could happen really quickly. But in the meantime, this might be that sort of transition month. Maybe it's a couple of months where the equity market takes these marginally worse data points as basically meaning, we have to just reduce the discount rate, and thus, if you reduce the discount rate, then equities should have a higher multiple and a higher price, and that would largely go in favor of growth stocks. Remember, growth stocks are by far the biggest contributor to the S&P 500, meaning growth basically means tech. So that's it, folks. This is kind of where we are here heading into September. I know this is a bit of a very near-term outlook. I don't want to usually be that near-term in terms of these Study Wealth podcast episodes, because it kind of goes against. But the reason I wanted to talk about it today in this episode is because of where we are in the economic cycle. This could be an important transition month or two or whatever. So I thought I would share this. And again, I know a lot of people do like sort of a more timely. This does not mean that we have to completely wet our beds in terms of our portfolio allocations, even tactical ones, and once nest egg 80-70% of one's liquid investments in let's say fixed income and equities should not be made on a one day's worth of trading action. Should be made on sort of a rolling basis. And we would be very happy to talk to you about that. If you have any questions on that, you can go to either bluemarlinadvisor.com and talk to us there from an investment advisory perspective, or you can go to thestudytrader.com and from more of a research independent research kind of standpoint. So hope it helps, folks. Have a great rest of your day wherever you are, and we'll see you again in the next Steady Wealth podcast.